Hey everyone, Jeremy Portnoff here, back again for another market update video. Plans to do a quick one today, so hopefully I don't go too long here. For those of you who don't know me, I've been in the financial advice business since 2002, and since then completed several professional education and credential programs, notably certified financial planner, certified investment management analyst, and chartered market technician, among some others. As always, the purpose of this video is to provide you with a general update of some of the recent developments in the financial markets, give you a sense of where we're at and what's happening, some of my thoughts. Before we begin, let's just take a quick look at the disclaimer. Go ahead and pause to read. Just remember, it's really important to understand that everybody's situation is different, and you should always consult with a qualified financial advisor to assess how this information may or may not apply to your individual situation. And if you'd like to discuss it with me, you're welcome to reach out, and we'll get in contact, schedule a call or something, and talk about what questions you might have. So again, I'm going to try to do just a quick update today and just review. I wanted to review a couple technical tools and signals that I used to kind of help us understand what the trend is doing, because it was kind of an interesting week. I'm going to skip the tactical portfolio review because I just did that last week, and just summarize it by restating that I've been and continue to be almost entirely in cash in those all the tactical risk models. So if markets do break down further, those strategies should do great. If you want to see a little bit more detail, you can watch last week's video. So the question I'd like to address today is whether technical analysis is voodoo or just something that most people don't understand. I had this discussion with someone recently, a friend, and if they watch this video, they'll know this is where the topic came from. And it's one of those things where, have things changed, and it's just something that some people are not familiar with. And I think that's a debate that can very well continue for a long time. But I'm going to show you a couple things here today, so it's pretty interesting. All right, here we go. So let's start by just reviewing the markets in general. So again, we're looking at S&P 500. A couple of notable things that have happened. Let's zoom in here. Remember, we had that retest of those June lows. Actually, I'm sorry, retest of the June low around the 29th. We did break through them on the 30th. We had that little rally there, and it came right back down. Now, on Thursday, the 13th of October, big day. The market opened substantially lower, and you can see how low it went here. We're going to talk about that some more in a minute here, but it was on the higher than expected inflation data. So kind of as I suspected, the market freaked out, and it dropped quite a bit early in the morning, early in the trading day. But then you can see what a huge bar that it put in there, meaning it traded up several percent that day to close much higher. And it's one of those things that I think, just kind of addressing the matter of opinions for a moment, I get lots of questions from time to time. What do I think is going to happen? What if this happens? What if that happens? What if the midterms this or the midterms that? The presidential election this, the presidential election that? And we all kind of have our opinions and our views of what can happen. And I think this is kind of case in point. My opinion was the market was going to freak out if the inflation data was higher than expected. And I was partially right because it opened up a whole lot lower, right? But then for some inexplicable reason, it traded like crazy and drove prices up very high that day. I mean, I think a lot of people were kind of in shock and going like, what's that all about? And it's evidence to the fact that what we think is going to happen and our opinion may be justified by data or reasonable expectations. Sometimes the market just does something completely opposite. And that's why at the end of the day, and kind of to this point today, about technical analysis, we still want to look at the overall trend, what's happening, what are the signals that we're getting, because our opinions can sometimes lead us astray, right? Now, notably, we'll see that on Friday, the market traded down quite a bit, and again, also notably closed basically retested these lows here and here, and I think we've established kind of a support range. So clearly we're trading below those June lows by about 1.5%. Now, I do think it's notable that the market had opened and was trading significantly below that. And I think that, at least on an intraday basis, is a break of that range. However, it hasn't closed significantly below that yet. So we do see that little bit of support. So all the moving averages are pointing down. Everything is pointing down. It just doesn't look good. You can see in my color-coded chart here, which is just looking at the difference between that 5 and 50-day moving average. It's a pretty wide distance, meaning that the shorter moving average is starting to move down faster than that medium term average. So that's not a good sign. You want to start to see some convergence of that to expect that the market is going up. Now, even when that convergence is happening, it doesn't necessarily mean that the market's going up. Like you can see during this period, market's going up a little bit, but a lot of the convergence is because that moving average is starting to flatten out. So let's take a look at market breadth real quick. We can see here that the percent of stocks above the 200-day moving average is only 14%. This is for S&P 500 again. And the percent above their 50-day moving average is only 10. So again, you've got most stocks trading well below these moving averages, showing a broad participation in this downward market. Now, we've talked about volume plenty, and that's one of the things I kind of want to hone in on here today. You can see, let's pull this out here. Generally speaking, when this peak happened here in mid-August, you can see generally from that period, as the market is traded down, volume is going up. But as we've gotten into this period here in the last like 2 weeks or so, it's really kind of choppy. It looks like the down days had slightly lower volume, but there's plenty of chop there. So it really doesn't feel like it's a very clear signal right now. But that's where we're gonna take this a little step further and look at something. So let me hide this price range here so we can get a better look. You can see where those June lows were and where we are now. So we have closed below that. We have broken through, not by a convincing amount, but nonetheless it is down. We get this little bounce here, we get a retest. We get a bounce from that 1 day retest, right? So this is where I said last week we're at a real critical level here because the market is trying to be supported right here, and it's causing some buyers to push it up. But is that going to be enough? And that's kind of the trick here, right? Is what does that mean? Okay, one of the things that I do look at, I wanted to point out too, is relative strength, and I want to, kind of to this question of, whether this stuff is voodoo or not. The relative strength gives us a sense of where price is relative to price over a prior period, and we can see in the chart here when it gets up here and it looks red, that means it's oversold, and when it's down here and it's in green, it means that it's I'm sorry, I apologize. That when it's up here, meaning it's overbought. There's too much upside, expecting reversal. Down here will be oversold. We would expect a reversal. Sometimes these movements give us, signals. Sometimes they don't, right? But I'll give a point here. So we can see. Let's pull this back a little bit. We see this peak right here. The RSI was kind of high, right? It backed off in that little bit of dip, and then it went even higher. But price went higher too. Right? And so that's consistent with the trend, right? But then as you start to get to the top, you see that RSI, it backed off. It was coming up here, but you see right in this spot here, you've got prices higher than it was here, but the indicator itself is lower. It's things like that are divergences. It's a negative divergence, and it gives us kind of a sense of, maybe there's going to be a reversal. When we combine things like that with volume, right, and you can see again, volume was really starting to drop off right here as well. And so we start to combine those signals, and then we get an indication, wow, gee, it looks like there's not a lot of energy or gas, if you will, for the market to continue going further. Now, did I know that the market was going to turn around there? No, nobody did. You never know what tomorrow brings. But what we have here are some indications that are not obvious unless you know what to look for. And that's kind of the point about technical analysis is in studying this craft, we learn about these different things, that different pieces of data that tell us something different, and then we use that to kind of infer what's going on and what's happening. Now, are those signals 100% right all the time? Absolutely not. Sometimes they're right more than they're wrong, which is why they get used, but they give us just an indication. Maybe it gives us a sense to kind of be on guard for something. Or perhaps if what we think is going to happen based on these signals starts to happen, then it kind of confirms that idea, and then maybe we can act on that, right? And so you kind of see that in different spots, right? And so, for example, RSI was getting kind of high here as it was peaking, but it wasn't as high as it was here at the peak. But price was also lower, so that's a little bit confirmatory as well, right? So back here, that August peak I mentioned before a couple of videos ago, right? You can see that relative strength indicator showing that it's really, really overbought. When we look at the volume during that time, remember that volume had been increasing on that trend, and then volume started to back off. And we see, again, we kind of combine those two things. Okay, we've got declining volume while price is going up. You've got the indicator itself that is really overbought, right? And it just makes it feel like there's just not some energy there, and sure enough, it turned down, right? As we're looking at that indicator right now, we can see that just before we got to this recent bottom, it was looking oversold, right? And so you do see a little bit of a rally, but this RSI hasn't really stayed up. It's kind of continued to go down. So it's really kind of more confirming that downward trend. So I want to take things a little bit further with this idea of volume and talk about on-balance volume. This one's a little bit more technical, but it's really a fascinating thing. What is on-balance volume? So it's something that's used kind of a lot in the technical analyst circles. Basically, the idea is that on days when the prices are closing higher, it's assumed that all the volume represents the buyers. And on lower days, the volume is controlled by the sellers. And so this volume is then added or subtracted from a cumulative value, which is what the on-balance volume is and what that line is there. Now, some consider this to be kind of the granddaddy of all volume indices. Whether that's true or not, matter of debate. But basically, we're taking that daily data, we're accumulating it into this index, and we're adjusting for the direction of the price change. Now, why is this important? The idea behind the on-balance volume index is really that this high volume in one direction and low volume in the opposite direction should confirm price trend, right? So if high volume is not confirming the price trend, then light volume in the price trend direction and heavy volume in the opposite direction suggests impending reversal, right? So if we look at this line just by itself, it's really not helpful, but we want to observe its trend and its action relative to price action. So let's go back and look at some of those periods that I just mentioned. So here we're back in September, right? On-balance volume is increasing, the market is increasing, that's fine. The market's backing off, on-balance volume is backing off. Same thing, it's rising again. So far, it's consistent. But now, similar to RSI, we can see what's happened here since November 8th of 21 up to the peak in January, is you can see that the market generally rose, but that on-balance volume was declining. So now, again, we've got some of that negative divergence, which is implying, okay, well, the indicator is going down, but price is going up. And so it kind of says that there's not a lot of volume pushing that price up. This would have been a warning signal, right? And we see this in kind of other places. Now, meanwhile, since the market has gone down, you see that on-balance volume going down as well. You get a rally in here, right here, that was leading into March. That on-balance volume is increasing, but really not a lot. Right? It means that even though those are up days in the market, you're not seeing the volume accumulate enough to make it really feel like it's a strong trend and, a reversal in the trend starting. Okay, so we see that going down. Now, you might recall back during this time here with the June lows, and let me find that triangle pattern. There we go. There's that triangle pattern happening, right? We hit that low, we bounce, kind of bounce in this triangle pattern. Look at that on-balance volume during the time. It was really just kind of going sideways, right? But then we get a breakout, right? And that on-balance volume was starting to increase. But then look at what happened. It started dropping off even though price was going up. This was another indication that said this trend, price is going up, but gee, the volume is just not there, right? And you add that to things like the RSI, right? RSI was getting oversold or overbought, right? So we kind of put these things together and we say, gee, price is going up, and if we're not in it, we're feeling frustrated that we're not in it, but we have a valid reason now to kind of proceed with caution at the very least, which is in fact what I did, as well as the fact that we were hitting that resistance point with that trend line in the 200-day moving average, which was notable. So again, kind of put those things together, sure enough, the market turns around. Why does this happen? Is this all just crazy coincidence? Or is it that all the other, big funds, traders, the market participants that actually set prices, they're all looking at this stuff, right? And it's why I'm looking at it, right? It's like, if you want to play the game, you got to know the rules, right? Whereas the average person investing and just simply hoping for the market to go up and hoping their 401k goes up is just completely unaware of most of this stuff. And again, this is why I study this stuff. This is why I took such a deep dive into it and why I'm so fascinated with it, because it does not appear to be just coincidence. It appears to be things that are linked together and kind of make sense. Excuse me. So again, as we see the market has gone down, that on balance volume has continued to drop. We get a little rally there, get a little blip in that on balance volume, but not much, and then it's falling again. So now, right now, if we zoom in here to this period, you see that price is kind of bouncing around this level, but it really hasn't gone anywhere in about 2 weeks. Yet that on balance volume is lower, right? That's something that is definitely a concern, because there's just not the volume there, right? So let's see for 1 second here. Bear with me. Okay, so again, we've got volume being kind of choppy, but this is where this on balance volume gives us a little bit more clarity on what's going on, because effectively the trend has been sideways, right? But the on balance volume direction is down. This indicates what we call distribution. It indicates usually a market top. Now, we wouldn't call this a top because it's already going down, but it could indicate, whatever attempts at a rally are happening here are just not enough. They're minor. So that's something. Now, why did we get this huge day on Thursday? This is the other thing I wanted to go over. And so let's hide a couple of these lines here. Let me hide that line there just to avoid some confusion. We've talked about Fibonacci levels before. These Fibonacci levels, there we go. It's like the Nautilus shell and the percentages as it rotates out. You see Fibonacci in a lot of places in life. And it's one of those things that someone could easily make the claim, well, this is VooDoo, right? But I'm going to show you something here. It's just absolutely fascinating, if nothing else. We are measuring from the bottom, the March bottom from 2020 to the top. That's our main market movement. And so when we draw those Fibonacci levels, we see we've got that 38.2% level. Remember, that's where we got a little bit of support here before that August rally, into the August rally that happened. And I said before that my next target down, that 50% level, was right around 3,500. You can't make this stuff up. Take a look at, right, here's that 50% level. Let's follow that line over. Look where the market hit a bottom right there on Thursday, 34.94, right at that 50% level. I mean, that's close enough, right? So the market essentially reacted very negatively to that inflation data, kind of as I expected. But there was an important technical level there. That's a 50% retracement of that main market movement. And other traders and the market makers, everybody involved in setting prices, they're looking at that 50% level. And I mean, we can't guarantee really anything in life, but I'd bet dollars to donuts that there were lots of orders already in the market at that level, that if the market hit 3,500 on the S&P, that there's going to be a lot of buying. And sure enough, and that's why you get this gigantic rally that happened on Thursday, because it hit that level and there's bounced from there. Again, I pose that question, is that just coincidence, or are these functions and data and things that other people are looking at that cause them to act, right? If everybody's looking at the same thing and it happens, then you get this broad-based action. And I find this absolutely fascinating. So anyways, we can see that the market did back off on Friday. And if we look at the weekly candlestick, right, we can see here, still looks like a downtrend, right? We had a slightly positive up week last week, but this week is technically a downtrend. And with us breaking through on at least an intraday level, it still looks like that downtrend is in effect. So, we'll keep an eye on it. I think, we break through to a real convincing degree, meaning like a close below these levels here, then I say there's going to be probably a lot more selling happening. And, we want to be prepared for, a lot of craziness ahead, right? Because markets, when they do end a downturn, they usually do it in kind of a more spectacular fashion. So volatility remains pretty high here on the VIX. Both mid caps and small caps are also trading very close to their lows. There we go. So mid caps a little bit off of the June low, so you're seeing a little bit more resilience there in mid caps. Small caps are closed just slightly above those lows, but pretty close as well. A lot of what's driving this is that 10-year Treasury. 10-year Treasury closed above 4% for the first time in a very, very long time, which is causing further losses in the bond market, and that's causing problems in the stock market too. And that's going to continue with this high inflation data. It's almost guaranteed now that the Fed is going to raise rates again at their next meeting. So all that same thesis of going into recession, I mean, we're headed that way anyways, is just more strength to that. So again, aggregate bond index is down, continues to go down. Right, we're down about 16.5% from that November period, almost 18%. So aggregate bonds about to hit bear market territory here any day now. Average mortgage rates approaching 7% there. That's likely gonna be the popping of the real estate bubble. Yield curve continues to be fairly inverted. We can see how inverted it has been and continues to be. That's that recession indicator. And I had this new chart that I figured out where it kind of looks at that yield curve over time. So you can see not only was it positive back here, but rates have been increasing both in the short term and the long term, but we can see how that yield curve is flat. And you can see down here where it's inverted. So that's kind of interesting. So anyways, well, maybe a little bit longer than I wanted to, but hopefully this provides some insight on what I'm looking at. If you have any questions, just reach out, or you can click the button that should be at the top of the video if you're watching it in the original format. And just let me know if you have any questions. Thanks for watching.